Welcome to Examination Techniques in CA2.4 Taxation and DA10 Taxation. To make the presentation, my name is Chitambo Mwape. So we'll start the presentation by looking at the general competences you are expected to demonstrate in these two papers. Then we'll look at the most common weaknesses which students sitting for this paper make, resulting in poor performance. We'll end our presentation by looking at the examination answering techniques which will ensure that you perform well in these particular examinations. We look at the general competences you are expected to demonstrate or to acquire after having completed these two courses. So you're expected to be able to describe the principles and role of taxation in an economy. Then you are also required to be able to compute the tax liabilities for different types of taxpayers, including sole traders, individuals in employment, individuals running partnership, as well as limited companies. You should also be conversant with the tax administration procedures, relating to the collection of direct taxes. You should be able to deal with VAT computations. You should be able to compute value-added tax, customs and excise duties, and finally, you should be able to identify and respond appropriately to ethical issues arising in the course of performing tax work. Now, let us have a look at the general weaknesses which most candidates sitting for these papers demonstrate, which results in poor performance in the examinations. So one of the most commonly made mistakes include the use of wrong tax rates to compute the tax liabilities for different taxpayers. So instead of using the individual tax bands for individuals when calculating the tax liabilities of individuals, you may find that a student is using the tax rates for a company. Similarly, when computing the tax liabilities for a company, you'll find that students are using personal income tax bands instead of the company income tax rate. Secondly, failure to distinguish allowable from disallowable expenditure when computing taxable business profits for different types of businesses, be it partnerships, limited companies, or sole traders. Then when it comes to the taxation of employment income, failure to distinguish between taxable and exempt benefits. Another topic where students make a lot of mistakes is the value-added tax. So failure to deal with VAT computations on different types of supplies. Then some students also demonstrate just general poor exam technique, such as poor time management, poor handwriting, and poor presentation of their work. Finally, another common mistake is misunderstanding question requirements or question spotting. It is important to be able to read the questions requirements carefully so that you are able to answer the question which the examiner has set. We look at topic-specific weaknesses. Now, when it comes to tax principles and purpose, one of the most commonly made mistake is failure to apply the criteria used to determine the residence of persons. Okay, so it is important that you are able to determine the criteria which is used to determine whether an individual is resident in Zambia, as well as the criteria which is used to determine whether a company is resident in Zambia for tax purposes. The second topic in which candidates face challenges is the topic dealing with the taxation liabilities for individuals, businesses, and companies. Here we are looking at the taxation of sole traders, the taxation of partnerships, as well as taxation of companies. In determining the tax liabilities for these different types of businesses, it is important that you are able to compute the tax-adjusted profits for each one of these different types of businesses. Now, one major weakness demonstrated by students is the inability to identify from information given which expenses are allowable and which expenses are not allowable. It is important that you are very conversant with the rules which are used to distinguish between expenditure which is allowable for tax purposes from that which is not allowable. Then another challenge is making incorrect adjustments when it comes to investment income when computing the taxable business profits. So we want to look at an example on how you deal with investment income when computing the taxable profit for a limited company. And we are using a question from the CA2.4 examination for the December 2022 sitting, question 1. So our focus on this question is just how we deal with investment income. So investment income was given in note number 6. So the question stated that the company in the information Daco Farms company received other income according to note number 6 in form of dividends from a Zambian company, and that income was stated was the net amount after withholding tax was deducted at source. Royalties was 22,000, and the figure of 22,000 was gross, meaning inclusive of withholding tax. The company also received bank deposit interest of 10.2, and it was stated net of withholding tax deducted at source. So how do we handle that? So when we are computing the taxable business profits for the company, we are supposed to deduct the exact figure for investment income which was included in the question. So for example, the dividends received from the Zambian company was stated net of withholding tax already removed at source. So when you are making the adjustment, you deduct the exact amount which was included in the statement of profit or loss. In this case, the figure was stated net of withholding tax. Even you are going to deduct the same figure of 34,850 without grossing up the figure. Similarly, if in the statement of profit or loss, the figure for investment income is stated gross, meaning that is inclusive of withholding tax, even you remove the gross amount. So in this case, the royalties received by the company were 22,000, and that figure was inclusive of withholding tax. So in the computation of the taxable business profits, even you are going to deduct the figure of 22,000. Finally, bank deposit interest received by the company was 10,200, and that figure was stated net of withholding tax deducted at source. So even you, when you are deducting this investment income in the computation of the taxable business profits, you deduct the figure of 10.2 without removing, without crossing it up to include the withholding tax which was removed at source. So at this stage, it doesn't matter whether the withholding tax on that investment income is a final tax or not. What we are interested in is to deduct whatever was included as investment income. And we have made a point that if the figure for the investment income was stated gross, even you deduct the gross amount. If the figure was stated as net, even you remove the net amount. At this stage, we do not bother with grossing up the figure. So we look at how this question was supposed to be practically answered by looking at the solution, so that we demonstrate or illustrate how you are expected to deal with this particular type of income when computing taxable business profits. So, as you can see in the solution, when it comes to deducting the investment income received by this company in form of the dividends, what we have deducted is exactly the amount which was included in the statement of profit or loss, which was 34,850. Similarly, when it comes to the royalties, we have deducted the exact figure which was included within the statement of profit or loss, which was 22,000. And finally, when it comes to bank deposit interest, we deducted the exact figure, which was 10,200. So you can note that in the question, the figure for bank deposit interest was stated at the net amount. When we are adjusting taxable profit, we do not gross it up. We don't gross that up at that stage. Our interest is to deduct the exact figure which was included within profit or loss. So after we have deducted the investment income in the manner we have illustrated, and you have now computed your final taxable profit, you now identify which of that investment income suffers a withholding tax which is not fine. So you need to bring back that investment income as you do your company income tax computation. So it is at this point where you have to make sure that the figures you are using for investment income is the gross. And at this point, you do not bring back the investment income which suffers a withholding tax which is not fine. So as you can see in the solution, we have started with the taxable farming profits, which was 21,49,200. Then we bring back the investment income. We are referring to it as the non-farming income. In fact, that is what we have started with. So we have started with the royalties. So the royalties were stated at the gross amount in the question, so we don't need to cross that one up since the figure is already stated gross, meaning it is inclusive of withholding tax. Then the bank interest was given net of withholding tax in the question. When you are now computing the company income tax payable, when you are preparing your company income tax computation, you have to make sure that the bank interest is now stated at its gross amount. Since in the question it was given as 10,200 net of withholding tax, you gross the figure by multiplying that figure by 100/85. The dividends, we do not bring it back into the company income tax computation. Why? It is because dividends suffer a withholding tax which is not final, and therefore it is not subjected to any further tax. That's why we have left out the dividends when computing the final company income tax payable by this company. Then, since this is a farming income, the non-farming income, which is the investment income, is taxed separately using the normal company income tax rate of 30%. Then the farming income is also taxed separately at 10%. After computing the total company income tax liability, in this case the total company income tax liability after you have added the income tax on the non-farming income, which is the investment income in this case, and after you have added the tax on the farming income at 10%, which translated to 2,014,920, and you add the tax, the company income tax on the non-farming income, which was 751,440. The total tax liability for this company is 2,766,360. So any tax already deducted at source is now deducted. In this case, this company received royalties and bank interest on which withholding tax is not final. The withholding tax was already deducted at source. So at this point, you deduct the withholding tax which was already deducted at source on the royalties. The withholding tax was 15%. The gross royalties were 22,000. So you charge the withholding tax which was deducted at source at the rate of 15%, and that gives you 33. Then also the bank interest, the withholding tax deducted at source was 15%. The gross bank interest was 12,000. You charge the withholding tax at 15%, and that gives you 18. So you can note there that when it comes to lessing the tax which has already been deducted at source, we don't include withholding tax on the dividends, because dividends in the first place, we never brought them into the company income tax computation because they suffer a withholding tax which is fine. That's why they won't appear anywhere in the company income tax computation. Another challenge faced by students sitting for these two papers regards the computation, or relates to the computation of capital allowances. In this particular area, common weaknesses include using the wrong rates to compute the wear and tear allowances available on the different types of implements, plant and machinery, including the industrial buildings as well as the commercial buildings. You are encouraged to refer to the taxation table. So the examination paper always contains the taxation table showing the rates at which capital allowances are charged on different types of implements, plant and machinery, as well as buildings. In some cases, you find that students will use the income tax value to compute the capital allowances. Always bear in mind that capital allowances are computed using the original costs. They are computed on a straight line basis. Then another area of weakness is failing to compute the correct amount of balancing charges and allowances arising on the disposal of different types of implements, plant and machinery. Specifically, in a situation whereby an item of plant or machinery or a building is sold for proceeds which are higher than the original cost. Whenever implements, plant and machinery or buildings are sold for an amount which is above the original cost, always bear in mind that you must restrict the proceeds which you are going to use to compute the resulting balancing charge to the original cost of that asset. Another area where students usually face major challenges is to deal with VAT in questions on capital allowances involving VAT. Sometimes a question on capital allowances, the examiner may give the figures, the original cost of the assets, either at the VAT inclusive value or a VAT exclusive value. So where the original costs of the assets are stated at VAT inclusive values, always bear in mind that capital allowances must always be computed using the VAT exclusive value. So if the original cost of the asset is stated inclusive of VAT, you have to make sure that you convert that VAT inclusive value into a VAT exclusive value, and that is what you use to compute the capital allowances. So an easy way of converting a VAT inclusive value into a VAT exclusive value for the purposes of computing capital allowances is to get the VAT inclusive value I've been given in the question and multiply it by the fraction 25/29. When you do that, it will give you the VAT exclusive value of that asset. So, as a general rule, as long as the cost of the asset is inclusive of VAT, always charge capital allowances using the VAT exclusive value. The only exception to that rule is where you are dealing with an asset for which VAT is not recoverable. And this is mainly or usually for motor cars. Input VAT on motor cars is not recoverable, and for that reason, when computing capital allowances on motor cars, you are supposed to use the VAT inclusive value. But for all other assets, always use the VAT exclusive value when computing capital allowances. So if you are dealing with a motor car and you want to compute the capital allowances on that motor car, in the case where the figure, the original cost for the motor car is stated at the VAT exclusive value, we have said that input VAT on motor cars is not recoverable, and because of that you are supposed to use the VAT inclusive value. So if in the question the original cost of the car is stated exclusive of VAT, you have to compute the VAT which is chargeable and add it, convert the VAT exclusive value of the motor car into a VAT inclusive value, because for motor cars you are supposed to use the VAT inclusive value to compute capital allowances. Now, the quickest way of calculating the VAT inclusive value of an asset where you have been given a VAT exclusive value is by simply getting the VAT exclusive value and you multiply that by the fraction 29 over 25, which is the same as 116 over 100. So again, let us look at another example coming from a past examination question. This time we are going to look at the September 2022 CA2.4 sitting, and we are going to look at question 1 so that we demonstrate how we are supposed to compute capital allowances in questions where the assets are stated inclusive of VAT. So we look at an example from CA2.4 September 2022 sitting, and specifically we are interested in note number 7 on implements, plant and machinery. So when you look at this question, some of the assets were stated at their VAT inclusive value. So the first two assets, the pool car, was stated at the VAT inclusive value of 127,600. The office furniture was also stated at VAT inclusive value of 139,200. Then if we jump to the acquisitions, the assets acquired during the year, which included the purchase of a Toyota Fortuner car, you can see that all those acquisitions were stated at VAT exclusive values. Okay, so we are saying that always when it comes to costs which are stated at VAT inclusive value, as a general rule, always compute the capital allowances using the VAT inclusive value. So for example, on the office furniture, the capital allowances were supposed to be computed using the VAT exclusive value. So the office furniture was, the original cost of the office furniture was 139,200, which was VAT inclusive. So we are saying the quickest way of converting the figure of 139,200 to a VAT exclusive value is by simply multiplying the 139,200 by 25 over 29, then you charge the capital allowances at the rate of 25% on the resulting VAT exclusive value. Then similarly, when it comes to the purchase of the Toyota Fortuner motor car, which was acquired on 9th January 2023 at a cost of 450. So we said for motor cars, capital allowances must be charged using the VAT inclusive value. Now, in the question, the 450 the 450,000 kwacha, the original cost of the car, was stated VAT exclusive. So you convert it into a VAT inclusive value because VAT on motor cars is not recoverable. So the quickest way of converting the 450,000 into a VAT inclusive value is by simply multiplying that figure by 29/29. So we are going to demonstrate how we should have calculated these capital allowances, the capital allowances on these assets, by looking at the solution for this particular component or part of the question. Okay, so as you can see in our solution, look at the office furniture specifically. So we were told in the question that the office furniture was acquired at a cost of 139,200, and the 139,200 was inclusive of VAT. So we are saying for all assets, always use the VAT exclusive value. How do you calculate the VAT exclusive value if the figure you have been given in the question is inclusive of VAT, as was the case with the office furniture? We said the quickest way is simply to get the VAT inclusive value, which in the case of the furniture was 139,200. You multiply the 139,200 by the fraction 25/29. It will give you the VAT exclusive value of the furniture. So you use the 120 now, which is exclusive of value added tax, to compute the capital allowances. In fact, the office furniture, when you look at the question, was sold during the year, and we are never given the income tax value. So we convert, first of all, the VAT inclusive value of the office furniture into a VAT exclusive value, then using the figure of 120,000, which is VAT exclusive, we charge the capital allowances on office furniture at a rate of 25%. We had used it for 2 years before it was sold in the current year, so that the income tax value at the beginning of the current year is 60, and then we compare that with the disposal proceeds to arrive at the balancing allowance arising on the disposal of the office furniture. So the emphasis there is that if the figure is given VAT inclusive, always use the VAT exclusive value in the manner we have demonstrated. When you look at the Toyota Fortuner car, we said VAT on motor cars is irrecoverable, and because of that, we must always use the VAT inclusive value to compute capital allowances on such assets on which input VAT is not recoverable. In the case of the Toyota Fortuner motor car, the 450,000, which was the original cost of the motor car, was stated at a VAT exclusive value. But for motor cars, we must use the VAT inclusive value, and we say the quickest way of calculating the VAT inclusive value, if you have been given a VAT exclusive value, is simply to multiply the VAT exclusive value by the figure by 116%, as we have done in that case, or you multiply it by the fraction 29/25. It amounts to the same thing. So in this case, once you calculate the VAT inclusive value of the motor car, then you charge the capital allowance at 20%, and it gave us 104,400, as we have demonstrated there. So that is how you deal with questions involving value added tax when computing capital allowances. Further challenges are faced by students when computing capital allowances on industrial buildings and commercial buildings. So apart from challenges arising when dealing with capital allowances on implements, plant and machinery, students face further challenges when dealing with capital allowances on buildings. So in this particular area, most students fail to determine the component of a building which will qualify as an industrial building, and the component which will be classified as a commercial building. So apart from that, students also normally face challenges in terms of using the wrong rates to use to compute the allowances on the buildings. So for commercial buildings, the rate of the wear and tear allowance is only 2%. Then when it comes to industrial buildings, the normal wear and tear allowance is 5%. But for buildings which are new or which have been purchased new, they also qualify for an initial allowance at 10%, as well as an investment allowance at 10%. But always bear in mind that the initial allowance and the investment allowance are only available on brand new industrial buildings. If the industrial building has been bought second hand, or it is one which has been used in prior years, then the initial allowance and the investment allowance will not be available. Then when it comes to taxation of farming operations, it is important that when dealing with a question on farming operations, you separate the farming income from the non-farming income. So if it is a company receiving both farming and non-farming income, it is important that you separate the farming income, which is taxed separately at the rate of 10%, and any non-farming income is also taxed separately at the normal company income tax rate of 30%. Similarly, if it is an individual running a farming business and also received some non-farming income, we start by first of all taxing the non-farming income which the individual generated from non-farming operations using the normal graduated tax bands for individuals. Any farming income generated by the individual must be taxed at the rate of 10%. In terms of accounting debts and basis of assessment, this is another topic which creates challenges for students. Specific weaknesses in this particular topic includes failing to apply the commencement and cessation rules, as well as the rules which apply when a business changes an accounting debt. Then also further challenges arise when it comes to dealing with capital allowances on the commencement cessation of a business, as well as on the change of an accounting debt. So it is always important that you go through these rules so that you are comfortable, you are thoroughly conversant with these rules so that you can easily apply them in the examination. We look at taxation of income from employment, and the main weaknesses, main challenges when it comes to dealing with taxation of employment income includes failing to explain the basis of assessment for employment income. So the basis of assessment for employment income is the receipts basis. It is important that you are able to explain the basis of assessment for employment income. Then students also fail to distinguish between taxable and exempt emoluments. Again, this is an area which you need to make sure that you go through such that you are able to easily identify which of those emoluments, which of those payments received by an employee are taxable and which ones are exempt. Then when dealing with taxation of employment income, it is also very important that you pay particular attention to the debts, because there are situations where an employee may have started employment partway through the tax year. So if you do not pay particular attention to the debts, then you are going to make wrong computations of how much of the employment income is supposed to be subjected to tax in a particular tax year. Then you also need to know which payments made from emoluments from employment are allowable and which ones are not allowable. Then you also need to bear in mind that statutory payments such as NAPSA, NEMA are also not allowable. Then Also, when dealing with employment income, it is important that you know how to deal with the pay as you earn, already deducted at source from the employee's pay. So the pay as you earn, which is deducted at source from the employee's pay, we deal with it after we have computed the tax liability of the employee. Then the payee, which has already been deducted at source, is given as a tax credit. We don't treat the payee as one of the allowable deductions in computing the taxable emoluments from employment. Pay as you earn, you deal with it after you have computed the tax liability of that employee on the gross. You have computed the gross emoluments. Using the gross emoluments, you compute the income tax liability for the employee using the graduated tax bands. Then from the total tax liability, that's where we deduct tax which has already been charged at source, such as pay as you earn and other payments, other taxes such as withholding tax. Then, when dealing with taxation of individuals and employment income in particular, one area which is not handled well in examination is the treatment of investment income received by such an individual. So you know that when we are dealing with an individual, apart from receiving employment income, may also receive investment income from other sources. So when we are preparing the personal income tax computation for an individual, we normally aggregate the income the individual has received from various sources: employment income, investment income, and business profits if that individual was in employment. So in the personal income tax computation, we must never include investment income received by an individual which suffers a withholding tax, which is fine. We only include investment income which suffers a withholding tax, which is not a final tax. So we are going to look at another example. This one we are getting it from the DA10 September 2022 question paper, so that we illustrate how we are supposed to deal with investment income received by an individual in employment. So we look at an example from the DA10 examination paper for September 2022 sitting. It was question 3. In this particular question, we had this individual in employment, who, apart from receiving employment income, also received some investment income. So the investment income was given specifically in note number 5. So in note number 5, we are told that the individual, Mwika, received investment income in form of fixed deposit interest, treasury bill discount. So our interest is on how that income is supposed to be dealt with when computing the income tax liability for the individual. So Mwika received fixed deposit interest, treasury bill discount of 8.5, copyright royalties of 27,200, dividends from DXT PLC, a company listed on the Lusaka Securities Exchange, and dividends from EPX, a private limited company. And we were told that all this investment income was net of withholding tax deducted at source. So how do we deal with this investment income when computing the income tax liability of an individual? So as we prepare the personal income tax for the individual, we aggregate the income from all sources. In the case of Mwika, she only received income from 2 sources: the employment income and the investment income we have just highlighted. So when we are preparing the personal income tax computation, and specifically when we are dealing with the investment income, in the personal income tax computation, we only include the investment income which suffers a withholding tax which is not final. Any investment income suffering a withholding tax which is final must never be included in the personal income tax computation because it is not supposed to be subjected to any further tax. Now, when you look at the investment income WICA received, fixed deposit interest is taxed at 0. Treasury bill discount, the withholding tax is 15% and it is a final tax, and therefore we should not include it in the personal income tax computation. Similarly, the dividends from DXT PLC suffers withholding tax at 0% fine, and we won't include it in the personal income tax computation from WICA, as well as the dividends which she received from EPX, a private limited company. Dividends from a private limited company suffers withholding tax at 15%, which is a final tax, and as a result, we do not include it in the personal income tax computation of the individual. Meaning that the only investment income we are going to include in WICA's personal income tax computation will be the copyright royalties, because copyright royalties suffers withholding tax at 15%, and that tax is not a final tax. Now, when we are including the investment income in the personal income tax computation, always make sure that the figure you include should be the gross figure, the figure which is inclusive of withholding tax. So in the case of WICA, they have told us to say, oh, this investment income she received was net of withholding tax at source. How do we know? It is because the question is saying the above amounts were the actual amounts received by WICA in each case. Therefore, as we prepare the personal income tax computation, we are required to gross up the copyright royalties, which are 27,200, by multiplying the figure of 27,200 by 100 over 85, as we have illustrated in the solution. So let us look at the solution so that we show how you're supposed to deal with the investment income received by an individual. Okay. So let us look at how we have dealt with the investment income WICA received during the tax year. So, as you can see, we started first of all by dealing with employment income. When we are dealing with an individual, we always aggregate income the individual has received from all sources. In the case of WICA, she had employment income, but we are more interested in how we deal with the investment income for the purposes of this question. So as you can see, in the personal income tax computation from WICA, we have only included the copyright royalties which she received. And because we are told in the question that the copyright royalties amounting to 27,200, the 27,200 was stated net of withholding tax deducted at source, so we cross it up. So we have included only the copyright royalties because withholding tax on copyright royalties is not a final tax. We have not included all the other items of investment income she received, which included dividends from listed and unlisted company, the interest income she received, because that type of investment income suffers a withholding tax which is final and should not be included in the personal income tax computation for an individual. So you only include in this computation investment income on which withholding tax is not final in the manner we have done there. So after crossing up the copyright royalties by multiplying the 27,200, the net amount she received, by 100 over 85, it gives us 32,000. We aggregate that with the employment income she received. The total gives us 229,745. We deduct the allowable deductions, which amounted to 45,900. It gives us the final taxable income of 183,345. We then subject the total taxable income of 183,845 to the graduated tax bands for individuals, and it gives us a tax liability of 41,252. After we have computed the tax liability from the final figure, that is where now we deduct the tax already paid. And here we are particularly interested in the withholding tax on the copyright royalties. So the gross copyright royalties was 32,000. So withholding tax on the royalties, as you can see there, is 15%. 15% of 32,000 will give us 48. So when we are deducting the tax already paid, we don't bring in any withholding tax on the investment income which she received, which was a final tax. We have not included any withholding tax on the dividends she received, both from the company which is listed on the LUSE as well as the company which is not listed on the LUSE. And we have not deducted any withholding tax on interest income she received. So only deduct in the personal income tax computation as a tax credit the withholding tax on investment income on which the withholding tax is not fine. Any investment income which was not included in the personal income tax computation in the first place should not be any withholding tax on investment income which was not included in the personal income tax computation in the first place should also not be deducted in this computation. You only deduct withholding tax on investment income on which withholding tax is not a final tax, as we have demonstrated in the case of the royalties. So another topic which creates challenges for students sitting for these papers is the administration of taxes. The specific area of interest on this topic are the due dates for the payments of different types of taxes. So when it comes to this topic, it is important that you know the due dates for the payment of different types of taxes. You need to know the administrative procedures relating to different direct taxes. So for example, you need to know that the due date for the payment of payee deducted from the employee's pay is the 10th day following the end of the month in which the payee was deducted. Similarly, withholding tax is payable on the 14th day following the end of the month in which the payment was deducted, the withholding tax was deducted from the payment. Turnover tax also is due on the 14th day following the end of the month in which the sales were made. Mineral royalty tax also 14th day following the end of the month in which the minerals were sold. Then you also need to know how the self-assessment system operates. You score easy marks in an exam by simply being able to identify the correct due date for the payment of tax under the provisional income tax system. You know that the quarterly payment of advance tax, the quarterly installment payments for provisional income tax is due on the 10th day following the end of each quarter. Then any balance of income tax payable at the end of the year is due on the 21st June following the end of that particular tax year. You also need to know the due date for the submission of the various returns which are used under the self-assessment system and provisional income tax. So for example, the return of provisional income must be submitted by 31st March of that particular year, whilst the self-assessment return, which is completed at the end of the charge year, is due for submission on the 21st June following the end of the tax year to which it relates. You'll be able to score easy marks by being able to explain the consequences arising from the late payment of income tax as well as the late submission of returns. So for late submission of returns, the consequences depend on whether the taxpayer is an individual or a company. So if the taxpayer is an individual, the penalty arising is 300 kwacha per month or 1,000 penalty units per month or thereof. If the taxpayer who has submitted the returns late is in fact a company, then the penalty is 2,000 penalty units, which is the same as 600 kwacha per month or part thereof. If income tax is paid late, there are two consequences. There is a penalty of 5% of the tax due per month or part thereof. Then on top of that, interest is charged on the overdue tax, and the rate which is used to calculate the interest is the Bank of Zambia discount rate plus 2%. Let us look at property transfer tax. When it comes to dealing with questions on property transfer tax, some of the major weaknesses include a failure to identify a property which is chargeable under property transfer tax. So you find that students will even compute property transfer tax on chattels, implements, plant and machinery, which falls outside the scope of property transfer tax. So you need to know the definition of property, what qualifies as property in as far as the Property Transfer Tax Act is concerned. Then it is also important to know how the realized value of the different categories of property are determined. Then also you need to understand the rules which are applied to determine the realized value of property transferred to an immediate family member. You need to know how to deal with transfers to immediate family members. Then additionally, you should be able to identify exempt transfers, because you find that in examinations, students will calculate property transfer tax even on transactions which falls outside the scope of property transfer tax. Value-added tax is another topic which poses major challenges for students. And when it comes to value-added tax, some of the major weaknesses include failure to distinguish between taxable and exempt supplies. So it is important that you are able to identify from the information given. You should be able to identify which of those supplies are taxable, which supplies are exempt, and which supplies are zero rated. Then when it comes to computing input VAT, it is important that you know that some input VAT is irrecoverable. So from the information given in a question, you should be able to identify supplies on which input VAT is recoverable, because that is another area where students make mistakes. They will be busy charging input VAT, claiming input VAT on expenditure on which VAT is not recoverable, such as entertainment expenditure, expenditure on the domestic accommodation of directors, input VAT on motor cars. So it is important that you are able to identify the type of input VAT which is not recoverable. Then another challenge when it comes to VAT questions is failure to apply the partial exemption rules for businesses making both taxable and exempt supplies. Failure to make VAT calculations on supplies which are stated at VAT inclusive values and on supplies which are stated at VAT exclusive value. So when it comes to computing both output VAT as well as computing the amount of input VAT which will be recoverable on a supply, some useful formulas you can use to make calculations include the two formulas presented there. So if the supply you are dealing with is stated at its VAT exclusive value, because in the examinations the values of the supplies you are given are either stated at their VAT exclusive values or they are stated at their VAT inclusive values. So if the supply you are dealing with is stated at its VAT exclusive value in the question, the quickest way of calculating VAT is simply getting the VAT exclusive value and you apply the VAT rate. Of course, for standard rated supplies, you know that the VAT rate is 16%. Usually, those are the types of supplies on which students faces challenges when it comes to computing both the output VAT, which may be payable, or the input VAT, which is recoverable. So as long as the figure for a supply you have been given is VAT exclusive, simply get the VAT exclusive and charge the appropriate VAT rate, which for standard rated supplies is 16%. Then, if the figure you are dealing with is stated at the VAT inclusive value, specifically for standard rated supplies, so you have been given these standard rated supplies, and you have been given this standard rated supply, and the figure is stated at its VAT inclusive value. The easiest way to calculate the amount of VAT applying to that particular figure is simply you get the VAT inclusive value and you multiply that using the fraction 4/29, which is the same as 16/116. All right, so we want to look at this example coming from the CA2.4 December 2022 examination session, so that we illustrate how we handle some of the areas which students find difficult in the examination. So one such area is how to apply the partial exemption rules when you are dealing with a business which is making both taxable supplies and exempt supplies. So when you look at this particular question, specifically question 1, we were told that the total sales of this company were 9,200,000, and they have given us the breakdown of those sales. Out of the 9.2 million, standard rated sales were 5,520,000. Zero rated supplies were 3,220,000, whereas exempt supplies accounted for, exempt supplies were 460,000 of the total sales. So it means when it comes to recovering input VAT on the expenditure, the general overheads specifically, we won't be able to recover the input VAT in full, because part of that input VAT will be attributed to the exempt supplies. So how are we going to calculate the recoverable non-attributable VAT on the overheads? We are going to focus on note number 4, specifically the miscellaneous overheads. So the note number 4 is telling us that the standard rated overheads incurred during the month totaled 532,440, and they are saying that figure is VAT inclusive. And they have given us the breakdown of those overheads. Input VAT on entertainment expenses is irrecoverable. Input VAT on the staff refreshments also irrecoverable, as well as the input VAT on the expenses on the director's accommodation. So from the given information, you should be able to easily pick the type of expenditure on which VAT is not recoverable in the manner that we have done. On the miscellaneous overheads amounting to 232,000, we will be able to recover input VAT, but not in full, because part of that expenditure will be deemed to have been incurred in relation to the exempt supplies, because this company is making both taxable and exempt supplies. So to calculate how much of the input VAT can be recovered on the miscellaneous overheads, we use the partial exemption formula. So the partial exemption formula is stated as total taxable supplies over total supplies, then multiplied by 100%. So we are going to demonstrate or illustrate how we are going to practically do that computation by looking at the solution here. So we want to demonstrate how you deal with the recoverable non-attributable input VAT, and in this case we are using the miscellaneous overheads. So the formula which we use to calculate the recoverable non-attributable input VAT says you get the total taxable supplies, you divide by the total supplies, then you multiply by 100%. So when you look at the question, we were told that the standard rated supplies for the month were 5,520,000. Then the zero rated supplies were 3,220,000. So we have added the two. Then the total supplies, that is all the sales, taxable supplies, zero rated supplies and exempt supplies, all together we are told in the question that amounted to 9.2 million. So when we get the total value of the taxable supplies, that is, we add 5.52 million plus 3.22 million, then we divide by 9.2 million, it is giving us 95%. So that is the percentage which we are going to use to determine how much of the input VAT incurred on the miscellaneous overheads will be recoverable. So we were taught in the question that the miscellaneous overheads were 232,000, and that figure was inclusive of value added tax. Remember what we said earlier on. If you have been given a VAT inclusive figure, as is the case here, the quickest way of calculating the VAT included within the 232 is by multiplying the VAT inclusive figure, which is 232, by the fraction 4/29, which gives us 32,000. Now, since this company is making both taxable and exempt supplies, we are not able to recover the 32,000 in full. How much of that 32,000 we are going to claim is determined by the partial exemption formula, and we, using the partial exemption formula, we determine that only 95% of that can be recovered, and that will give us 30,400. Then, also, just to emphasize the point, remember we said that if you have been given a VAT exclusive value, the standard rated sales, for example, 5,520,000 was stated at its VAT exclusive value. So we said if the figure you have been given is VAT exclusive, to calculate the VAT, you simply get the VAT exclusive value and multiply it by the VAT rate, which in this case is 16%. So to calculate the VAT on the standard rated supplies, the standard rated sales, you simply get the figure which was 5,520 and you multiply by the VAT rate, which is 16%. Similarly, the standard rated purchases in the question, the figure we were given, we were told that it was VAT inclusive. When you look at the question, the standard rated purchases were 3,016,000, and we were told that that figure was VAT inclusive. In fact, we were told that the 3,016,000 were the total purchases. Out of those total purchases, only 70% were made from registered, were purchased from registered suppliers. No wonder we are saying 70% of 3,016. Now, since that figure is inclusive of VAT, we say the quickest way of calculating VAT, if the figure you have been given is inclusive of VAT, simply get the VAT inclusive figure and you multiply that by the fraction 4/29. So the standard rated purchases were 3016, out of which only 70% were purchased from traders who are registered for VAT. Then, since the figure is inclusive of VAT, we simply multiply it by 4/29 to determine the amount of VAT which is arising, which is 291,200. Then expenditure such as entertainment expenditure, staff refreshments, and expenses on directors' accommodation, we say the input VAT on such items is not recoverable. So the examiner will usually ask you to indicate such items, to indicate that the VAT is not recoverable by using a 0. No wonder we have used the 0 on each one of those items. So we now look at another topic, customs and excise duty. When it comes to this particular topic, main challenges or weaknesses include failing to determine the correct VDP for customs and duty. When it comes to customs and excise duty, challenges include failing to determine the correct VDP for the purposes of determining customs duty on imported motor vehicles. So the VDP is calculated by adding the purchase price of the motor vehicles, insurance, freight, and other incidental charges or costs incurred up to the point of entry into Zambia. Any costs incurred within Zambia should never be included in the determination of the VDP for customs duty purposes. Another challenge is using the wrong exchange rate when converting the VDP for customs purposes into Zambian kwacha. So you should always use the rate approved by the Commissioner General of the ZRA. Now, when it comes to computing the customs duty itself arising as well as the excise duty, the main challenge there is using the wrong taxation table to compute those import taxes arising. So in the examination, you are given two tables. The way we determine the import taxes arising on the importation of motor vehicles depends on whether the motor vehicle which has been imported is a brand new motor vehicle, or the motor vehicle which has been imported is a second-hand or used motor car aged 2 years and above. So even in the taxation table, we are given two taxation tables. So when dealing with this particular aspect, it is always important to read the question carefully so that you identify whether the motor vehicle you are dealing with is a brand new motor vehicle, or whether the motor vehicle you are dealing with is one which has been used before and is aged 2 years and above. Because students usually make mistakes. You find that the student is using the table for used motor vehicles when the motor vehicle they are dealing with in the question is a brand new motor vehicle. Similarly, the motor vehicle you are dealing with is a second-hand motor vehicle, but the student is using the table for a brand new motor vehicle to compute the import taxes arising. So again, we are going to illustrate how you are supposed to handle this particular aspect by looking at another example. This time we are getting a question from CA2.4, March 2022 sitting. So we look at how we compute import taxes arising on motor vehicles, and we are using the question from CA2.4, March 2022 sitting, so that we demonstrate how you are supposed to deal or compute these import duties arising. So, like we mentioned earlier on, it is important to identify whether the motor vehicle in the question is brand new or it is a motor vehicle which has been used before, a second-hand motor vehicle aged 2 years and above. So the question will be very clear. So when you look at this question, the taxpayer Rashid, or rather Mr. Ashraf Ashraf Patel purchased two motor vehicles. The first motor vehicle, the Toyota Camry sedan. The question is saying this was a brand new motor car. So the first sentence just under the Toyota Camry sedan, the question is saying he acquired a brand new 2,360cc Toyota sedan car. So that is the key. So you know that to compute the import taxes arising, you must use the table for brand new motor cars. So we are going to demonstrate right away how that is done. But you know that before you can compute the import taxes arising, first of all, the first step is to compute the VDP for the purposes of assessing customs duty. And we mentioned that to determine the VDP for the purposes of computing customs duty, you only include the costs incurred on that motor vehicle up to the point of entry into Zambia. That is, the purchase price of the motor vehicle, any insurance charges, freight charges or transportation charges up to the point of entry into Zambia. Any costs incurred within Zambia are not included in the determination of the VDP. So that if we apply that to this Toyota Camry, which was imported, it means that the list price of 12,000 must be included. The question says that the taxpayer also incurred or paid freight charges up to the port of Dar es Salaam amounting to 3,500. We are going to add it also. Then clearing and forwarding agency fees at the port of Dar es Salaam were 2,000. Incidental costs incurred to transport the vehicle from Nakonde to Lusaka amounted to 800. So like we mentioned, any costs incurred within Zambia are not included in the determination of the VDP. So the incidental costs incurred to transport the vehicle from the Nakonde border post to Lusaka amounting to 800, the motor vehicle registration fees in Lusaka amounting to 300, and road tax of 250 won't be included in the determination of the VDP for the purposes of computing the import taxes arising on the Toyota Camry. So we can now illustrate how the import duties will be assessed, because we have said we are only going to include the price of the car, which was 12,000, the freight charges up to the port of Dar es Salaam of 3,500, and the clearing and forwarding agency fees at the port of Dar es Salaam, which were 2,000. So let us illustrate by looking at the solution how we are going to compute the import taxes arising on the Toyota Camry. Remember, we are saying this is a brand new motor vehicle. So let us look at the solution. So as you can see in the solution, after adding the purchase cost, the freight charges, and the clearing and forwarding fees, the total is $17,500. Like we mentioned earlier on, to convert the foreign currency into Zambian kwacha, you always use the rate approved by the Commissioner General of the ZRA. In the context of this question, we were told that the appropriate rate to use was 22 kwacha per US dollar, so that when we multiply the 22 by the 17.5, it means the VDP for customs duty purposes in Zambian kwacha is 385,000. Once you have computed the VDP for customs purposes, the next step is now to determine the taxes, the import taxes arising. So the first import tax we assess is the customs duty. From there, you assess the excise duty. Then finally, you assess the import value added tax. And we have mentioned that the way we are going to assess these taxes depends on whether the motor vehicle you are dealing with is a brand new motor vehicle, or whether it is a used or second-hand motor vehicle. In our case, the sedan, we were told in the question, the Camry was a brand new motor vehicle. So we are going to go to the taxation tables so that we pick the correct rates at which the import taxes will be assessed. So like we mentioned earlier on, there are two tax tables which are given in the examination paper. So the first one is the table for customs and excise duty on used motor cars. So we are not going to use this one because we have been clearly told that the sedan was imported brand new. So you go to the next table, this one, saying customs and excise duty on new motor vehicles. So for brand new motor vehicles, the rate at which customs and excise duty arises depends on the type of vehicle which has been imported. And for this purpose, brand new motor vehicles are classified into 4 groups, as you can see there. So the first category or classification are the motor cars and other motor vehicles, including station wagons, principally designed for the transport of less than 10 persons. The second category covers pickup trucks, lorries, with a gross weight not exceeding 20 tons. Third category covers bus coaches for the transport of more than 10 persons. Then you have the final category, which covers trucks, lorries with gross weight exceeding 20 tons. So you need to identify or to determine under which category the motor vehicle you have been given in the question is falling under. So we are dealing with a brand new Toyota Camry sedan. So obviously a sedan is not a truck, it is not a bus, it is not even a pickup. So it is falling under the first category. So the rate at which the customs duty will arise on the first category, which is the motor cars and other motor vehicles, principally designed for the transportation of less than 10 persons. So the rate of the customs duty, which is what we have to assess first, is 30%. So as you can see there, they are saying on this category of motor vehicles, customs duty is chargeable at 30%. So that is the rate we are going to apply to the VDP we determined earlier on. Once we assess the customs duty at 30%, we then assess the excise duty. So we then assess the excise duty. So the excise duty on this type of vehicles depends on the cylinder capacity of the vehicle. It depends on the cylinder capacity of the vehicle. So if the cylinder capacity of the vehicle is 1,500 cc and less, we use 20%. Then if the cylinder capacity is more than 15 cc, we use 30%. So in the case of the Toyota Camry car, we will demonstrate now practically how we will charge both the customs duty and the excise duty. So let us illustrate in our solution how that is done. In fact, when you look at the question, the cylinder capacity of the Toyota Camry sedan was above 15 cc. So when it comes to excise duty, we are going to charge the excise duty at 30% since the cylinder capacity of the vehicle is above 1,500 cc. So we have said the customs duty will be 30%. The excise duty depends on the cylinder capacity, and since the cylinder capacity of the Toyota Camry is above 15, we use 30. So we'll illustrate how that is practically done in our solution. So as you can see, we started first of all by determining the VDP for the purposes of assessing customs duty, and we found the value of 385,000 in Zambian kwacha. So we say the next step is now to assess the import duties arising, and we said we start first with the customs duty. And we have just demonstrated that according to the table for brand new motor vehicles, for this type of motor vehicle, the excise duty, the customs duty is chargeable at 30%. So 30% when we apply it to the VDP for customs purposes of 385 gives us 115,500. So we add the customs duty to the VDP for customs purposes, that is 385 plus 115,500 kwacha gives us 500,500 kwacha. That is what we use to assess the excise duty. Remember, we said excise duty on this category of motor vehicles depend on the cylinder capacity, and from the question, the cylinder capacity of the Toyota sedan was above 1.5, and for that category of motor vehicles, the correct rate of excise duty is 30%. So the 30%, when we apply it, multiplied by 500,500, it gives us 150. So we get 500, 500, then we add 150,150 kwacha, it is giving us 650,650 kwacha. So that is the amount we now use to calculate the import VAT. So import VAT is the last import tax which is charged on the importation of a motor vehicle. So 16% of 650,000 gives us 104,104. Then we can sum up all the import taxes, starting with the customs duty, which was 115,500, the excise duty, which was 150, and the import VAT, which is 104,104. The total is 369,754 as the total import taxes arising on the importation of the Toyota Camry sedan. We get back to the question so that we also demonstrate how we are going to compute or assess the import taxes on the other vehicle, which was a used motor vehicle or second-hand motor vehicle. So we look at the other vehicle which was imported by the taxpayer. Now this one, we are told that it is a second-hand Toyota Noah station wagon. So what is important is to identify whether the vehicle you are dealing with is brand new or second-hand. So obviously the Toyota Noah is second-hand. So again, the first step will still be to determine the VDP for customs purposes. So we add the purchase cost, which was 3,600, insurance charges of 600, transportation costs of 1,600, up to the point of entry, up to the Nakonde border costs. As like we have already said, incidental costs incurred within Zambia, the incidental costs incurred to transport the vehicle from Nakonde to Lusaka, which amounted to 300, where clearing charges with Interpol amounting to 950, the motor vehicle registration fees of 300, and road tax of the motor vehicle registration fees of 3,000, and the road tax of 350. All those costs were incurred within Zambia. Therefore, we won't include them in the computation of the VDP. So we'll only include the purchase cost of the motor vehicle, which was 3,600, the insurance charges of 1,600, to arrive at the VDP for customs purposes. Then after that, we'll assess the import taxes arising. So let us demonstrate how that will be practically done as we look at the solution. So as you can see in the solution, in determining the VDP, we have only included the costs incurred up to the point of entry into Zambia, which were the purchase cost, the insurance cost of 600, and the transportation costs up to the point of entry into Zambia. Any costs incurred within Zambia are not included. So it gives us 5,800 when we add 3,600 plus 600 plus $16. That gives us $58. Again, we convert that into Zambian kwacha using the rate approved by the ZRA, which was 22, and 22 times 58 gives us 127,600. After you have determined the VDP, the next step is now to assess the import taxes arising in terms of customs duty, excise duty, and the import VAT. So to do that, we have to go to the taxation table. So, like we mentioned earlier on, we have two taxation tables. We have the first one, which is customs and excise duties on used motor vehicles, and the table we used earlier on, customs and excise duties on new motor vehicles. So the NOA is a second-hand motor vehicle, so we are not going to use the table for the new motor vehicles. We use the earlier table, which deals with used motor vehicles. So again, used motor vehicles are categorized into different groups. So you need to identify under which category the vehicle in the question is falling under. So the vehicle which was imported, the question said it was a station wagon. So it was not a sedan, it was not a hatchback, but it was a station wagon. So for imported motor vehicles, you need first of all to know the type of motor vehicle which was imported. In this case, it was a station wagon. Then you also need to know how old the vehicle was, the age of the vehicle from the time of manufacture. At the time you were importing it, what was the age of the vehicle from the time of manufacture. And for that reason, they are categorized into those motor vehicles aged 2 years old but less than 5 years. Then we have those motor vehicles which are aged 5 years and over from the time of manufacture. So we need to identify whether this station wagon, so there are two things you need to identify. So when it comes to station wagons, when you look at the table, we need to know the age of the station wagon, and we need also to know the cylinder capacity, because the rate at which both the specific customs duty and the excise duty will arise depends on the cylinder capacity of the vehicle and its age. So we go back to the question so that we are able to pick that information. We are looking for the cylinder capacity of the motor vehicle as well as how old the station wagon is. So we refer back to the question so that we pick that information. So as you can see from the question, the cylinder capacity of the Toyota Noah station wagon, the cylinder capacity is 1,990 cc. That information is important. Then secondly, we need to know how old it was, the age from the time of manufacture. So we have been told that it was manufactured in 2006. And this motor vehicle was imported in 2023. So you can see that 2006 to 2023, obviously the age is above 5 years. So the cylinder capacity is 1,990 cc, and the age is more than 5 years old since it was manufactured in 2006. And it was imported in the year 2023. So we can go back to the taxation table so that we can pick the relevant specific excise duty as well as customs duty from the table. So as you can see in the taxation table, the vehicle we're dealing with is a station wagon. We needed to know the cylinder capacity. The cylinder capacity is 1,990. So 1,990 cc is falling under the first category, which is saying cylinder capacity not exceeding 25 cc. 1,990 cc is obviously below 25cc. Then secondly, we needed to know how old the age of the station wagon, and we said it was manufactured in 2006. It was imported in 2023. When you count the years, they are obviously above 5 years. So we are looking at the two columns under vehicles aged 5 years and over. So when you look at that column and connect it to the row showing vehicles with a cylinder capacity not exceeding 25cc, you can see that the relevant customs duty is 9,024 and the relevant specific excise duty is 11,731. So we pick those figures and use them in our solution to compute the final or the total import taxes arising. Alright, so as you can see there, we are now doing the second part of the computation. We already determined the VDP, which was 127,600. Now we have just identified from the taxation table that the specific customs duty was 9,024, so it is just a matter of adding it to the VDP for customs purposes of 127,600, and the total comes to 136,624. Then secondly, we also picked from the table the specific excise duty, and it was 11,731. When we add the 11,731 to 136,624, it gives us the value of 148,355, which we must use to compute the import VAT. So 16% of 148,355 gives us 23,737 as the import VAT arising. Now, for motor vehicles aged 5 years and over, an additional surtax charge is imposed, and it is a standard charge of 2,000, which is also included in the taxation table. So when we get that standard surtax charge of 2,000 and add the specific customs duty of 9,024, specific excise duty of 11,731, and the import VAT of 23,737, it gives us the total import taxes of 46,492. That is how we deal with import taxes arising on the importation of motor vehicles. So now let us look at some of the techniques which can help you interpret the question requirements as well as effectively manage your time in the exam. So it is always important to make sure that you carefully read and understand all question requirements and content and context in each requirement. You should specifically pay attention to the following factors. Always identify the type of taxpayer you are dealing with in the question, because this will help you avoid the mistake of using the wrong rates to tax the taxpayer. Individuals, you know that generally individuals, we tax them using the graduated tax bands for individuals. If it is a company, you are going to use the standard company income tax rate of 30%. On top of that, it will also be important to identify the specific type of company you are dealing with, or the kind of activities in which the individual or the company is engaged in. If the company is engaged in farming, for example, you know that you won't use the standard company income tax rate of 30%. You are going to tax it at 10%. So that information is very important. You have to pay particular attention to such information as you are reading the question requirement, because it will affect the rate at which you charge any tax which will arise. Then it is also important that when you are reading the question, you pay particular attention to dates, especially when you are dealing with employment income, because sometimes you may find that in a question, this employee did not work for the whole tax year, yet you are given the annual salaries and other allowances, and you need to time apportion the taxable emoluments according to the number of months when the individual was in employment. So dates are very important because they may affect the computation of the amount of income which will be subjected to tax. And dates will also be important when you are dealing with a topic such as the administrative procedures for direct taxes, because they will affect the amount of penalties and any interest arising on any late payment of tax or on any late submission of tax returns. So that is the second point. Pay particular attention to dates. Dates are very important in determining the taxable income and ultimately the amount of tax which may be chargeable on a particular taxpayer. Then you must also pay a specific attention to the active verbs, because the active verbs indicate or gives you the instructions. They are the ones which indicates what you are commanded to do, what you are required to do in the question. Then time allocation, time management is important, and one way one technique which will help you manage time is to take note of the marks awarded for each question and the allocation of marks between different requirements within a question, so that you avoid the mistake of spending too much time on a question which has very few marks. So time allocation always gives you an indication of how much you should spend on a particular question or part of it. It is also important that you know the meaning of the different verbs which are used in the examination, because those are the verbs which are commanding you or instructing you on what to do in a particular question. If you misunderstand the question requirement, it means even the answer you are going to produce will be an answer which the examiner did not request for. So you need to know the meaning of the verbs which are used in these examinations, such as list, state, define, explain, describe, identify, illustrate, compute, prepare, apply, and so on and so forth. Then when it comes to your presentation, it is important that you plan your presentation properly. Then your handwriting must be legible. Obviously, no marker is going to award you mark if they cannot read whatever you have written. Then make sure that your answer is well structured. Give thought to what format to use and how long your answer to each part should be. So in taxation, you will use as much as possible standard workings. So use standard workings as much as possible for computational parts. There is a way we present a computation of the taxable business profits for a taxpayer, where you get net profit as per accounts, you add back disallowed expenditure, you less allowable expenditure not included in the accounts. There is a way we present even workings for capital allowances. There is a way we present a personal income tax computation for individuals. So as much as possible, make use of those standard workings. That is important because it helps the marker to locate the marks easily, and also it helps you to work your way through the figures in the question in a methodical and time-efficient way, because you are given, when you look at the scenarios which are given in these examinations, they are quite lengthy. But if you have a standard, if you use a standard working, it helps you to easily pick the kind of information you need for you to present your answer. Then it is also essential that you include all your workings in your answer and cross-reference your workings appropriately, so that you are easily able to show where the figures you are using in your answer are coming from. So your workings will earn you some marks even in a situation where by the final answer itself may be wrong. Then for discussion questions, it is always useful to use headers, headings, sentences, paragraphs, bullet points, and so on, because again, it makes it easy for the markers to see your points and award you marks appropriately. Always indicate the question number, always show which question you are attempting clearly, and remember to use the correct pen. Then avoid scattering your answer parts from the same question throughout your answer booklet, so that it is easy for markers to identify which particular question you are attempting, to identify which particular question the solution you have produced is for. This marks the end of our presentation. We were looking at examination techniques in CA 2.4 and DA10 taxation. And I wish you success in your exams.